Hi friends, Simit here from InformedTrades.com. In today's video, we're going to continue the subject we discussed in our previous video, which is jargon that bond investors need to know when they're getting started with buying and selling bonds. Let's get started. Okay, key points and terms we'll review in this video. Step coupon bonds, survivor options, what they are, putable bonds, and we'll also talk about the tax status of bonds and some things to consider when you're evaluating that. Step coupon bonds. These are basically bonds that are, the coupon rate escalates over time at fixed intervals. So you can see on the chart here, the bond, sample bond here, issued January 2013, starts with a 3% coupon rate, and it escalates over time, culminating in January 2023 at about 7.5% coupon rate of the face. 7.5% of the face value of the bond is the coupon rate. Now, one of the catches here is that typically with step coupon bonds, at the intervals in which the coupon rate escalates over time, the bond can be called, which means the investor can, the company or government agency issuing the bond can pay it off and discontinue issuing coupons. So that's something to consider. You know, the coupon rate, while it's scheduled to go higher, it may not actually go higher if the bond is called. Also, another point to consider is that many step coupon bonds are issued at rates that are below the market average at the time. So, for instance, in this sample example here, perhaps 3% for this type of bond is actually below average. There might be other bonds of similar quality that are issuing 4% or 5% or what have you, but the coupon rate or the step coupon is sort of the justification for issuing it below the typical rate, because it's going to increase in time and it's going to end up being above average. Of course, the catch to remember here is that if the bond gets called below or after if the bond gets called before the rate hikes come in, then of course as an investor you don't get to experience the higher coupon rate. So step coupon bonds are a little more complicated, a little more involved, but you can sort of get the idea. The basic concept is that the interest rate increases over time, and that when it does, typically the bond issuer has the right to call the bond. So they either pay it off or they pay a higher interest rate. Putable bonds. Putable bonds are sort of, in our previous video we talked about callable bonds. Putable bonds are the inverse of callable bonds in that as an investor, you have the opportunity to redeem the bond at face value at any time. So for instance, if you bought a bond from a government and you paid $10,000 for the bond, which means you let the government borrow the $10,000 and they were paying you 1% or 2% or whatever the interest rate was, and let's say 3 years in you actually need the $10,000, you can sell the bond back to the government at face value at the $10,000, so you get your initial capital back, you get your principal back, and you no longer get coupon rates. So putable bonds offer investors a little bit of liquidity security. So if you're worried about having your money tied up, some type of emergency or some type of other opportunity comes up, or if interest rates change. So that's something else to consider. It prevents your money from being tied up. It gives you a little bit more liquidity. Now, for that liquidity, you are going to have to pay a price. And putable bonds are typically, the price of a putable bond is typically the price of the bond plus the price of the put option on the bond. And a put option is, of course, the right to sell. And you can see it illustrated here on the chart. Putable bonds typically have a higher price, right, higher on the y-axis here, than a bond without that put option. So you are paying a little bit more for the bond. You're going to have a little bit of a lower yield as a result. However, you do have a little more liquidity options. So if you're concerned about changes in interest rates, you're concerned about the bond price volatility, or you're concerned about your own personal liquidity and the need to be able to liquidate your investments, putable options may be something that you're interested in. Tax status. This is a really important concept. It's real simple in a lot of ways. A lot of government bonds, basically, the income from it, the interest income you get from it, is not taxed. So if you bought a government bond that's issuing 3%, that 3% on your principal is not taxed. Corporate bonds, on the other hand, and many agency bonds are often agencies of the government. They're not technically a part of the government, but they're associated with the government. Those bonds are typically taxed as your normal income. Now, I should note that a lot of this depends on what jurisdiction you're in, whether you're in the United States, France, Germany, South Africa, Japan, wherever you are. The rules, obviously, of that government are applicable, and of course, those rules may change over time. As well as there may be, related to that, there may be some personal factors that the tax rules look to when evaluating whether your income from interest income is taxable. So definitely you need to understand your personal environment and your personal situation a bit more, but it is something that's really important to consider, because if you have bonds that are tax-free, that's, essentially, and you're comparing it to bonds that are going to be, where the income is going to be taxed, you have to factor that in when you're comparing those bonds, and whether, even if a corporate bond is issuing a higher yield, it may not be worth it when you have to factor in the fact that you have to pay tax on that income. So those are things to definitely want to consider. Survivor options. Basically what this means, let's say I have a bond, I pass away. A survivor option allows the beneficiaries I've listed to inherit the bond and to redeem it at par value upon my passing away. Of course, this is another thing where it depends on the jurisdiction you're in, right? What part of the world and what government. And there's lots of fine print here, lots of terms. So there's maximum amounts on survivor options, the kind of proof you have to provide. If there's a joint account and one survivor passes away, does it still work? Lots of things to consider here, so you really have to read the fine print. It often varies not only from jurisdiction to jurisdiction, but from bond to bond. So this is something you'd want to investigate a little more. Where it's really applicable is if you have a lot of capital and you're doing a lot of estate planning. It's at that point in time where you really want to plan for the future, plan for your beneficiaries, whoever's going to inherit your wealth, estates, and things like that. So that's where survivor options become really useful. And it's also, if you have an expert in this subject matter, it's probably a good idea to sort of get them involved if you have enough capital to really warrant it. And that's about it. Any questions you have, anything you want to add, join us at informedtrades.com. Best of luck in your trading and investing, and we'll see you next time. Take care.